All right, welcome to Dennis Money's 2 Cents, your weekly recap of headlines and stories. I'm Matt.
I'm Taylor.
And I'm Robbie.
Rabih, Taylor rocking the best mustache ever. Holy cow. It like makes me so jealous. So let's jump into this. Just to do a quick agenda, we have a Jackson Hole meeting update, an August market in review. We have some ridiculous headlines from Taylor. We were just reviewing these. They are long, and I don't know who in these departments, like their editors, thought this was a good idea. We're going to hit these, and then hopefully we'll have some time. If we do, we'll talk about a Vanguard study that talks about the average retirement savings. I always kind of like these, kind of gives you some perspective at a macro level. So let's jump in. Robbie, hit us with the Fed meeting and August market update.
Yes, I know you didn't sleep the whole week because I told you I was going to talk about the Jackson Hole meeting.
I
and what they're gonna
literally
talk about.
could not. I was so excited. I couldn't even focus on anything. I was so excited.
Exactly. So here's your moment. Sorry to deflate your bubble, but the meeting wasn't as exciting. Last year when it happened, he went on, he thought he had the job done, and the market rallied. Like the rally that we had August, September last year was right after the Jackson Hole meeting, because maybe he misspoke or something. So this time it was more concise, and the goal out of it is that, hey guys, the target is still at 2%, and while inflation is good, and goods in the goods sector is down and it's trending in the right direction in the housing sector, there's still work to be done on the services X housing. And he did not deviate away from the script, which the market got confused. Like, okay, so what do we get from this?
So like, what do we do now? Do we like this? Do we not?
Exactly. So it's like the target is 2%. But I found something so interesting related to GDP, because next week, here's another reason for you not to sleep this week. We're going to be talking about earnings, but this week wanted to talk about the GDP. I don't know if you're aware of, it's a model. It's also a website created by the Atlanta Federal Reserve called GDP Now, which in a sense is a model
I'm on
that
it every
tries...
day. I'm on it every day.
Exactly. So it's a model that tries to predict what the GDP growth is going to be in the quarter that we are in, instead of having to wait quarters and months for reports to come in and, for them to aggregate the data and tell you what the GDP is going to be. So
that's gdpnow.com.
No, but if you Google GDP Now, it's on the top links. And then you can go there. And it's the model actually works in a way where every time a new report comes up, whether it's like retail sales or like inflation report or the unemployment, they take those numbers, they reflect it into their model. And it's the Fed who's making the model. It's not like an analyst in some bank. And they spit out their projection for what Q3 is going to be. And in the last 2 weeks, retail sales came in so high and new housing for residential constructions came in so high that suddenly the annualized number for how much the GDP is expected to grow in Q3 is at 5.9%. This is how much you would, well,
but a recession's for sure coming, right?
Exactly. You need it to be negative, and it's saying
oh yeah, other way yeah.
On an annualized rate, it's going to be 5.9%. So if you take it quarter by quarter, they're just saying that in Q3 the GDP is going to grow 1.48 or 1.5% in just one quarter, and they were expecting for the whole year for it to grow by 0.5, which blows our mind away about how strong the American economy has been and how hard it's been to slow it down. And in retrospect, Q1, on like an actual number, the economy grew by 0.5%. In Q2, it grew by 0.59 or 0.6%. Tomorrow, we're going to get the second revision for what Q2 they think it's going to be. And their prediction for Q3 is 1.48%. So this just tells us that the US economy on real terms has grown or is expected to grow by the end of Q3 2.57%. You still did not hit Q4. And this does not show in any of those data that we're saying that a recession is coming. That's on one hand.
Hold up though, Robbie. Hang on. I keep seeing articles and tweets and doomsday, YouTube videos. Like, it has to happen, right? A recession is coming.
At one point in the future, it might come.
Yeah.
Well, that's on one hand. On the second hand, Now we have more debt than we thought we had. Credit card is at what, 1 trillion?
Yeah, over
We've
a
mentioned
trillion
this
now.
so many times. Interest rates are in the 5% level. So this means if you were running on a treadmill at speed 1, you're now running at speed 5. And how long can you keep running on a
Yeah,
speed
there's still
5?
risks, right? There's still legitimate
Right.
risks. Yeah.
The risks are elevated, but the data is still showing that the economy is still robust. I think you might need something to break externally for it to like trigger, domino effect and slow business activity down. But this is what's happening so far. This is how the GDP is like. The whole grain out of this is like, this is what the GDP is looking like. It's so far by the end of Q3 at 2.57% on a real term. Next week, we're going to be looking at earnings instead of the GDP and see the mismatch between what the economy is doing and what the market is doing and what like corporate earnings are doing. But to sum this up, let's talk about what happened in August in terms of the equity market returns for the US, China, because China was a big factor this quarter, and developed world, the rest of the market. If you include the returns of today, because they weren't like this yesterday, I had to update my numbers. The US is down only 2% for August. It was around 3.8% by yesterday night. China in August alone is down 8.16%. It
Wow.
was around 10 last night, just because today, Tuesday, August 29th, was a really good day in the market. They adjusted those numbers. And Europe is down 3.7%. So we're still in the technical bull market for equities, but this is a dip, and this is how it shows up. And the issues with China are still remaining. Big commercial real estate company defaulted on its debt, and the intervention by the Chinese central bank wasn't up to market expectations. So the sell-off is continuing, and we'll see how that will develop in the future. But this is August, and let's hope better numbers for September.
Two quick takeaways from that. The only things that I really heard: number one, college football is starting this week, and I learned that while everyone else is getting on ESPN.com, Rabih is going to GDP prediction websites, which tells me everything I need to know. The other thing I learned is that Rabih's getting better at teasers. You must be getting better. Like, you know what you're doing now. You are a professional content creator, because you are now teasing us every time we do a show about, hey, guess what? Fed meeting next week. And now next week we've got earnings. So make sure to tune in, like, and subscribe. You're getting really good at this. I'm very proud of you.
It's not like I'm talking about NBA or football. I'm talking about investments, you guys. So if I don't throw these teasers in, no one will listen.
Hey, yes, they would, Rabih, because you're that good. Anyway, I just wanted to point that out. I noticed this. Taylor, what do you have? Anything you want to add to Rabih's summary and teasers?
No, I'm just always amazed at Rabih. I mean, that man is 10 times
Blows
smarter
me
than
away.
I'll ever hope to be.
Blushing. Thank you, guys.
I totally agree with that, by the way. Every time I talk to Rabih, I had an investment committee meeting with Rabih earlier today, and I'm just sitting there just mesmerized by him and his intellect.
You guys humble me. I'm running out of content, so I don't really want to raise your expectations so much. I can only tease 1 week at a time.
Yeah.
So let's just go to what Taylor has.
That's okay. Okay. All right. We'll jump to Taylor. Taylor, these articles are amazing, mainly the titles. Let's hit what you have here.
Yeah, this is a perfect lead in for me, because as smart and as complex as Rabih is, I'm as incredibly simple and plain as it gets. I get teased in the office. I drink probably 2 gallons of milk a week.
And that, people, he's not lying, by the way.
I'm not, that's not a lie. So that's just, when it comes to, I was thinking about this podcast today, and I was like, what value can I bring that Rabih's not already going to bring? And I was just like, I really want to just talk hair.
Yes.
And I said, when I look at investing, I think about it in a very simple way. And I just wanted to go on to, what an average investor would do if they wanted to learn more about finance. So I went to Apple News and I put in finance into the search bar. And then I just pulled up what the top news articles were going to be. And there were 2 articles that just stuck out to me for several reasons. The first being just how incredibly long the titles of the articles were. So, for example, one of the articles was super rich Americans are giving up on the stock market and holding historical levels of cash Here's why and what they're plowing their wealth into instead.
That's the title.
It's the title.
That's the
That is
title.
the title. Like, it's so
Uh,
ridiculous.
Very. I just love the verb choice of plowing their wealth
Yeah.
into. I've just never even heard that
I've
before.
I've always wanted to know. I've always wanted to know what super rich Americans are putting, like, investing their money in. I've never thought about what are they plowing their money in? You know,
not
is it
just putting in,
farmland?
what are
Is
they
it
plowing?
farmland? I don't know.
Yeah, so we'll see. And really the thing that got me going reading these articles is we just got back last week from a CE course webinar where we went and met with Dimensional Funds, which is some of the companies that we do our investing with. And I was coming off a high, just like our clients, when you come off a CE where you're just like gung ho, I learned a lot, let's go. I was coming off this high where I was just so invested in what we were doing and our investment philosophies and just the stock market in general. And to read these two articles just got my blood boiling, where I was just like, how is this
Sober
even
Jep
legal?
real quick.
How is this even legal to put out to the world?
Yeah.
So anyways, let's dive into these articles. Again, the first one is, hey, here's the super rich Americans. What are they plowing their wealth into? The second one is rich young Americans have lost confidence in the stock market and are betting on these assets instead. Get in now for long-term tailwinds.
Of course, you got to get in now, guys. Because
So-
here's the irony of that. Here's the irony of that last sentence. Get in now for strong, and then they use the term long term. If it's long term, why the urgency to get in now? Anyway, I want to know who's editing these titles.
So both of these articles start with legitimate facts, right? They use two different facts and then they have a take on those facts. So the first fact was high net worth individuals held over 34% of their portfolios in cash as of January 2023. Last year, that cash exposure was only 24%. So there's been a 10% increase year over year. And this is the highest level of cash since 2002.
They've lost complete confidence. What are they doing? Like so they're plowing their money into cash.
So they're plowing their money into cash. They're taking it out of the market. They're putting it in other places. Is what this article is surmising and saying that what's happening. So those are what the numbers are saying, right? But then they say the reasons for this is they are finding better alternative investments, right? And I asked Matt and Rabih before this, what do you think? So they offered three things that were better alternative investments to the market. And I asked them, what do you think these three things are? Matt,
We did
what
get
did
two
you
of the
say?
three. We
What
got
did
two
you
of the
say?
three. Real estate, easily number one.
So you said real estate.
And then I said fine art.
You didn't start with fine art. You said
What did I say?
cryptocurrency.
Oh, crypto.
And then what was there was another one that wasn't fine art. And then I said, you're wrong. And then you said fine art.
Fine art. Yeah, I don't remember what
Right.
the other one. Rabih
I said private equity.
private equity. Yeah.
Right. That was it. So our
Yep.
guesses were real estate, private equity, and
Fine art.
cryptocurrency.
Oh, crypto. Yeah.
Right. And then Matt said fine art. So Matt eventually got to two of them. So they surmised real estate, fine art, and the third was a wine cellar. Right. So they said, instead of having your money in the stock market, a better place would be to put it in real estate, fine art, and a wine cellar.
I'm not going to lie, guys. They have me at wine cellar. I've always wanted a wine cellar. That's more of a lifestyle investment for me. Someday I will have one. I can't say it's a better investment than the stock market, but you never know. I guess if I'm a super rich American.
So
Nothing-
I wanted to ask you, Rabih, like this is what they're surmising. Why is there any other reason why you would think that we have had such an increase of people putting money into cash?
In cash, well, I'm hoping it's not cash and it's actually high yield saving accounts for a starter. But I'm guessing the fact that we had, a full decade of near zero interest rates for a while, people really kind of felt that, hey, the only place I can put my money is in equities. And now that traditional savings accounts are back, short-term bonds are back, people are just thinking that this is, a once in a lifetime opportunity. But if stuff stay as is, those are here to stay. And on the long run, higher risky assets will perform better than low risk assets. So things just, it's been a while and they missed them. I don't know.
Yeah, I want to know what I would love to know more about, like their data, to Robbie's point. And the other thing I just think, so meaning when they say cash, they're referring to like checking account, high yield savings account. That, I mean, that's a big deal. The other thing I'm curious about is when they say these super rich Americans, how many are business owners that benefited from government intervention with COVID? I only bring this up to say we still have dentists we see all the time that have higher levels of cash since COVID because of ERC, because of PPP, because of whatever it may be. So there's multiple government interventions. So I'm also thinking about that. Like now we are a couple of years removed, but like ERC stuff is still coming in for a lot of our clients. So how many of these are business owners? You know, maybe that has or played a role in this as well.
Yeah. Well, and according to their numbers, they said the vast majority of these people were in wealth preservation mode as opposed to wealth accumulation, which is, you know, a
Which
whole
makes
new
sense.
discussion in and of itself. But the other thing
Yeah.
I'd say is this was as of January 2023. Well, what happened before January 2023? We had 2022 was a really bad year in the stock market. So naturally, when you have a bad year in the stock market, what do people do? They get scared.
They
and
bounce. They do the exact opposite of what they should do.
What they shouldn't be doing, right?
Because what happened this year or this month, or sorry, this year?
Yeah, what's happened since January, Robbie?
US markets is up 19%.
So they're using this as like a tool of saying, hey, these are smart people getting into cash. And I'm looking at it the opposite way. And I'm saying these people locked in losses from the stock market in 2022 and missed out on all of the rebound in 2023, right? This is like class A of what not to do. And this article saying, hey, these people were smart and you should be getting into wine cellars, fine art, and real estate.
Hey,
which
really,
is just mind-boggling.
Really quick, Taylor, on this, I'm curious, and maybe you don't know because I know we just have like this on the doc, but did the article have links to like when they say, hey, this instead fine art, and then they had like masterworks or something?
Yes, they
okay,
did.
well, of course, it's an affiliate link.
Yeah, they had
Gosh,
affiliate
dang it.
links all over the place.
Yes,
right?
show me the incentive, I'll show you the outcome. There you go. They're incentivized to talk about these sponsored links.
But it just makes me afraid because again, I read it, I laugh at it, we laugh at it, but this is what the average person's going to do. I need to think more about money. Let me go pull up Apple News. Let me search finance and let me see what's going to show up. Right.
Yep.
And this is what's showing up there. And it's just like, be really careful. Right. They used legitimate data. Right. And then they went off on their own tangent.
They made a lot of assumptions.
A whole lot of assumptions. And again, to your point, just be double, triple checking like the reasons for writing the article. This person, the whole reason why they wanted to write this article is so that they could get affiliate revenue from all these links that they had.
Of course. Yeah, check the motivation for sure. Well, so speaking of that, Taylor, let's mention the second one, the second article and what that data is talking about.
Yeah, so the second article is, the first one is talking about super rich Americans. The next article is talking about rich young Americans. And so this was done by Bank of America. And they said, according to a recent study from Bank of America, individuals aged 21 to 42 with at least 3 million in assets only have 25% of their overall portfolios invested in stocks. Right, compared to 55% of wealthy investors over the age of 43. So essentially, ages 21 through 42, if you've got at least $3 million in assets, and I want to meet the 21-year-old that's got
I was going to say, ridiculous range.
So I take that for what it's worth. But if they have 3 million assets or more, only 25% of it is in stocks. And then anyone over age 43, 55% of their wealth is in stocks.
That's the cutoff, guys.
Saying,
you have 43, it's the cutoff.
Their point of this article, I mean, this one is just mind-boggling to me, is they're saying, hey, smart, wealthy, young investors are losing confidence in the stock market and they're investing in other things, right? That's why they're saying, hey, they're only 25% as opposed to over 40s, they're 55%. These younger millennials that are smart, rich millennials, they know what's up.
Yep.
And then guess what they proceed to do? They proceed to recommend that you invest in fine art.
No,
Same recommendations, different article, different
with
writer,
affiliate links.
with affiliate links. Right.
Brilliant. Was it Masterworks? Is that who it is?
I don't know. I'd have to go back and double check, but
Got it.
it honestly was just like mind-boggling, because the funny thing to this, and Matt, Rabih and I were talking about this before we jumped on, is a lot of our clients honestly probably fall into this. Anyone under the age of 42, they probably fall into this category with where they have at least $3 million in assets. And the vast majority of them do not have over 25% of their wealth in stocks, right? Where do they have their wealth?
Yeah, their their personal home, their practice, their commercial real estate. If they own a building, a lot of places other than the stock market.
I was talking to a client last week. He's in San Francisco, crushing it. His business is probably he's probably 35. His business is worth 1.5 million. He's got commercial real estate of 1 million, primary residence of over 1 million. So he's in this category, and he's saving
a rich young American,
and he's saving $10,000 a month in the stock market. And he asked me, he said, what do I need to do to diversify further outside of the stock market? Because everything I'm doing right now is in the stock market. How can I diversify outside of the stock market? And I kind of flipped it on its head. And I said, let's look at your balance sheet right now. And let's look at the assets that comprise your balance sheet. And when we looked at it, 56% of his net worth was in private equity or his business. 46% of his net worth was in real estate, between commercial and personal. And then I think it was 5% of his net worth
public
was
markets
in investable assets. And then the rest was in cash.
Yep.
Right. So I was like, guess what? Even you doing $10,000 a month, you still have over a decade to even get close to the percentages that you are invested inside of private equity and real estate.
Yep.
Right. Yep. And to me, this is much more the story than what they're suggesting in this article, that they're investing in other places. It's just the natural order of things, right? Typically, if you're a young American, you have to make money in your career and in other places before you can actually put money into the stock market.
Yeah, so true. The stock market investing is like you're now in like harvesting, right? You're harvesting all the hard work you've put into your career, but like that takes a long time, right? Rabih, you had something you were.
Taylor said something that caught my attention. The client was asking, how do I diversify out of the stock market? But in my mind, if you want to diversify more, just be in the stock market more. Because when you're just, packaging them as like real estate, private equity, and public markets, you're kind of looking at them as equals, but they're not in reality the same. Because the true risk is the stream of revenue. In your real estate, the stream of revenue is a rent that's coming to a couple of businesses or houses. For your private equity,
well, in this case, it's the practice, his practice.
Exactly. So the stream of revenue coming to that
revenue
practice
is the same for his private equity and his real estate.
Yep.
But when you're talking about public markets, like the stock market, you're talking about around 3,000 different streams of revenues going to like 3,000 businesses. So even if you're looking at them as like 3 equal categories, the amount of risk in each is completely different, especially the company specific risk. So no, if you want to diversify, add more to these 3,000 companies or to those 15,000 companies.
I was going to say globally, right? It's 15,000. Yeah.
Yeah. And that was the whole point of this, is like, he just thought, hey, I'm making really good money, but I'm putting in so much per month into the stock market. It feels like everything I'm doing is into the stock market. And he was forgetting that how much per month he was putting into his commercial real estate, how much per month he was putting into his practice, how much per month he was putting into all of these other things. And when we actually broke it down, he had a long, long way to go to achieve any semblance of diversification inside of his net worth.
Both such good points. And Rabih, to your point around, and these are like, to sum this up, Taylor, the articles you're referencing here are a dime a dozen, unfortunately. This is why he's asking this question. It's a great question. The guy is thinking about this in a very intuitive way because he's getting bombarded by articles like this. You should be in fine art. You should be in wine cellars. You should be in like private equity or whatever this other stuff is that seems sexy. But if you really dig down, this is just marketing. These two articles are literally marketing for people trying to sell you a product. So I understand the question, but Robbie, you make such a good point. If you really break down what this stock market, people hear the stock market, they just think it's like this one kind of like one thing.
Yeah.
It's like, no, it's actually 15,000 different companies that are doing 15,000 different things all over the world that you can own a piece of. It's so much more complex and diversified than people even give it credit for. So I'm totally with you. Any other thoughts on that, Robbie or Taylor? I love this. I think just be careful, right? Be careful with what you're reading and the motivations behind these articles. But anything else you guys want to add on that?
Like nothing is worse than a risky portfolio of stocks other than a financial asset you can drink and consume and disappear and get drunk on. Like I don't know. Wine for me is not a financial asset. Sorry.
It's great. We love wine, but not as an investment. Yeah. Okay. Last thing, we'll just wrap up with this. I love these types of articles. I just think it's honestly like good perspective to get like, I think it's really easy to get locked in your bubble of people that you surround yourself with, your, social media friends or work friends or whatever. And I think it's hard, it's really easy, I should say, to lose track of like the big picture perspective of like a progress of how well you're doing. And so, or maybe not how well you're doing, but I think most of the time you read this and you feel better. So this is there's a Vanguard study. So the title of this article, also long, here's how much the average 60-year-old American holds in retirement savings. How does your nest egg compare? So that's the title. But what it really breaks down is a Vanguard study found that those between 55 and 64, so 55 and 64-year-old Americans roughly had an average of how much in retirement savings. Guesses, my fine gentlemen. What would you say? Average.
I would guess
retirement savings.
250.
Okay.
We're not including their house. So yeah.
No, this is just retirement savings.
450.
Okay. Taylor wins. Holy cow, Taylor.
Right.
256,000 was the average. It's pretty amazing. And that was pure guess right there. But so then they break it down even further. That includes high income earning Americans, obviously, the people, because, when you talk about average, the higher numbers can skew that way up or way down. So they gave the median. What would you say the median is? The middle number in that distribution set?
Oh, much
lower. It skews lower. Yeah.
Any guesses?
Given the mean is 256, I'll say 150.
Taylor?
I'll go 175.
Okay, you guys are both a little high. It's 90.
Ooh.
90 is the middle number in that distribution set. So, which is kind of amazing. Like I was pretty blown away by this. 27% of those who consider themselves retired have nothing saved, no money. They're living off of Social Security. It's pretty incredible. So, there's not much to say about this. I just think it's interesting. I think it gives, like when we talk to clients, obviously dentists are in that high income earning, right, category, but this is 55 to 64-year-olds on average have 256. It's pretty wild. Like we can tell you from our data, our average client is 39. Now, keep in mind, this is net worth. I don't have the top of my head what their retirement savings are, but I'm going to guess it's somewhere double of this amount at 39. Their total net worth is about 2 million, our average client. So just, again, I like this to give some perspective to people out there. Sometimes it's hard to feel like you're making progress or like take a step back and be like, how am I doing? Hopefully most people out there hear this and they're like, all right, we're doing okay. Any thoughts on this, guys, as we close this out, Taylor?
Well, on the flip side of this is just don't compare yourself to the average, right? And whenever you hear what the average American is doing, don't try and do it. Just don't be average.
Don't buy fine
right?
art, guys. Yeah.
Like that's the thing is like a lot of these articles that are out there are written to the average American. They're not written to you as a dentist and these high net worth individuals. So just be really, really careful because you don't want to end up being an average American while taking average advice along the way.
Boom. We're going to close on that. Don't be
Yeah.
average. Don't be average. That was awesome. All right. Well, that was our 2 cents. Thank you for listening. If you're listening live, thank you. If you're listening on Friday on the podcast or over the weekend, thank you so much. We love doing these shows. Rabih, Taylor, thank you. And we will see you next week. Take care.